the sale of the garage unit will be treated as a capital disposal for tax purposes. Use of the word capital disposal, that is jargon. This whole episode is focused around how you can take tax jargon that you might be using right now in your tax advice and turn it into simple, plain English that clients will love you for. You just heard one tiny snippet from the episode that's to come, and that's just the surface of it. A lot more of the draft tax advice that I go through is much more complicated, and I'll give you examples of how wording can be turned into something much simpler and much better for the client. What you're about to hear comes straight from a recent webinar that I delivered called The Tax Lab, where I took draft advice from one of the attendees and went through it live in the session. You're listening to the Tax Professionals Podcast, the podcast that helps UK tax professionals become better. And I'm your host, Jack Bonehill. I'm an Employment Tax Director, host of this podcast, and tax skills trainer purely for tax professionals. So this is a summary of the situation. So we have a partnership, a husband and wife partnership, and they have, I think it's 2 units. I wasn't actually sure that it's 2 or 3 units, but they've got at least 2 units. One that's a non-trade unit and one is used in a garage, which I'm presuming is like a car garage, something similar to that. I don't think it really matters for the purpose of this. So some of these clarifications don't really matter. So we've got the husband and wife that are basically wanting to retire or to make the business smaller. So they just want to have the guy and no staff in the business anymore. It's been trading since 1998. They brought these units from the landlord back in 2012, so that's quite a while ago now, 13 years, and there was a mortgage attached to it. They opted to tax the units for VAT at the time, and the units are owned by the husband, not the partnership. So a personal owning of the assets, it's not owned by the partnership. Okay, so that's the main bits. And what I want to mainly focus on is like how the advice is written, how it's presented to the client, and how easy or difficult it's going to be for them to understand. Because being technical is an essential element of tax advice being good. And that's what all of us, or at least at some point, will become good at. But I think the thing that's more tricky is then taking that technical and turning it into something that's really client friendly. They have given me basically a snippet of some of the options from the report. So they haven't given me all the options, but they've just said that they've considered a few different ones, which are that the husband and wife, the partnership, continue as they are now. A different scenario that they just sell the non-trade units, an option where they sell both units, which is the one that we've got below. And there's another one where they rent out units to third parties. So the one that we've got to look through in a bit of detail here is this. And as I say, the main thing I want to be commenting on is like how good the advice is rather than the technical that's sitting behind the advice. I mean, for one, this isn't actually my area of tax. So I can't really comment that much on the technical because all I do know is what I remember from CTA, which at this point is very little about this. Okay, so we're starting to actually get to the tax bit now. So first off, it says income tax implications. So this is just going to be talking about income tax then, which is good. So what it says is, as no taxable income arises directly from the sale of the garage unit, being a capital disposal rather than trading income, there are no direct income tax implications. Okay, so I'm just going to pause for a second on this whole sentence because I think it's quite a complicated sentence that could be simplified for the client's benefit without losing its meaning. So I don't really know what the purpose of the word directly is here. Like, what is that adding to this sentence? Because I think you could probably just say no taxable income will arise from the sale of the garage unit. And we can drop the word directly. It might seem a small thing, but I don't really know what to say, which is making me think, is there a meaning behind it? Is there not? But I'm not sure based on the current wording. But the most complicated bit, I think, is this here. Being a capital disposal rather than trading income. Will a lay client really know what we're talking about here? Maybe they do. I don't know this client, obviously, so maybe this is fine for this client. But we can simplify it and it'll be more appropriate for more clients then as well as this one. I just think that can be dropped entirely. I don't think they need to know that it's a capital disposal rather than trading income. The fact is that they know that there's no taxable income on the sale of the garage unit is enough for me, so they can cut out the rest of it and it would still say the same thing in a much nicer way for the clients. And also, it's the same part. I don't really know what they mean by direct income tax implications. I'd probably get rid of that. Unless there obviously is a reason behind it, in which case I'd probably make it more clear what is meant by that. And it says, however, any revenue generated from the continuing trade in the new premises will remain subject to income tax. Okay, that's fine. That makes sense. Although you'd like to think, since it's the same situation that they have now, that they would know that already. And just as a knock-on effect for this, because they have been so thorough in like talking about the different income tax things here, I just thought, well, is it worth just commenting then? So again, not my area, so I could be wrong on the tax on this, but will the rent reduce taxable profits and therefore reduce the IT payable? Because since they're commenting so much on like all the different income tax and what you'll see in a bit as well, capital gains tax, it almost feels like an omission to not say this. So I'd either go for simple and only the points that are not obvious to the client, or be completely thorough, because that seems like an extra point that can add something there. Because right now I'm presuming they own them. Well, they do own them, but I'm presuming that the mortgage has been paid off. And even if not anyway, I'm sure the income tax will be a net positive here in terms of less being paid. So let's move on to the next bit then, the capital gains tax implications bit. So it says the sale of the garage unit will be treated as a capital disposal for tax purposes. Okay, so again, same comment as before really. This is quite complicated as it's written right now. Use of the word capital disposal, that is jargon, I would say, personally. Now, is what we can say just something as simple as the sale of the garage unit will be subject to capital gains tax, or capital gains tax will be due on the sale of the garage unit? That is saying, well, as long as I'm not missing something, 'cause it's not my area of tax. But to me, that's saying the same thing in a much more client-friendly way than what's currently being said. Then it says, provided the transaction is with an unconnected third party, the disposal proceeds will be taken as the actual sale price. So you can see all the bits I've highlighted here are all the bits that I think are basically more complicated than they need to be. And I'll be looking to remove the use of these words and terms entirely from this document to make it much more easy for the client to understand. So transaction is a more complicated word here than I think we need. Can we not just say sale, or something like, as long as the garage is sold to an unconnected third party? But then even we've still got the jargon there, unconnected third party. Do we need to use that or not? Can we, for example, give some examples of what would be an unconnected third party here to help them understand what that is? So I'm guessing it's going to be something like if they're family or close friends, or they live with them or something along those lines, they'll be connected. So it could say something like, provided the garage is sold to someone that isn't family, isn't friends, so on, so on. Could that be said instead? Because that would be significantly simpler than what is currently said. And if there is a really big list of what is and what isn't connected here for the purposes of capital gains tax here, then you could always list a few of them and say, but there's more. And if at the time you're coming to sell this, we can comment on this for you. Because what you probably wouldn't want a client to do is figure out for themselves anyway who is and isn't an unconnected third party. That's going to be a complicated thing to do, and we can do that for them as the advisor here. So anyway, let's carry on. It says, provided the transaction is with an unconnected third party, the disposal proceeds will be taken as the actual sales price. Okay, so what is meant here by disposal proceeds and actual sales price? I'm guessing this is the amount of money that they will receive in total for it. So can we say something more simple there, or at least explain what it means to the client? What is meant by actual sales price as well? So could we add in an example here? Could we say something like, if the garage sold for £500,000 to an unconnected third party, this is what it means? Because right now we're explaining it so that they can almost be like flexible and apply it to different circumstances. But what we could do is just apply it straight to their circumstances for them. And then this would be more tailored then to the client's specific circumstance. You'll see we continue with some of the complicated bits here. So it says the capital gain will be calculated based on the sale proceeds less the original base cost of the property. Now, I did CTA and I could not tell you exactly what that means either. So there's very little chance of a client understanding what that means. So I think this whole paragraph could be made into something significantly simpler. Could it say something to the effect of, selling the garage will result in capital gains tax being due. The amount due will depend on if it's sold to a connected or unconnected third party, and it will be based on the actual sales price and multiple other factors, which we can advise on at the point you're selling this, Or can they put in an example now saying something like, for example, based on this happening, this is the capital gains tax that will be due. Something like that. So it can be brought more into the client's world. So I'm doing this off the cuff, and it would be better if I was to sit down and write it. But hopefully you can get a feel for what I'm trying to do on this bit here. Let's carry on further then. So it says the garage unit is considered a business asset and therefore subject to conditions. Rollover relief may be available. Okay, fine. So the gist again of this paragraph is completely right in terms of the message that wants to be said. But I think again it can be simplified to make it easier for the client to understand. So do they need to know that it's a business asset, or do they just need to know that if they sell the garage, then they might be able to not pay capital gains tax right now in the current tax year, and they'll pay it in a future tax year? You are saying pretty much the same thing, but you're removing the term rollover relief and some of this complicated language that's being used. So what you could say is doing this is as a consequence of rollover relief, something like that. So they still know that that's what it is, but I would flip the script a bit. Start off by talking about like what the impact is before using like the term that describes what it is. I think that would have a better flow to it and be easier for the client to understand. So it says this relief, so rollover relief, allows for the deferral of a capital gain where the proceeds are reinvested into qualifying business assets. Okay, so can we say what's said here in lesser and simpler words? I think we can say something like, when the garage unit is sold, you won't have to pay capital gains tax in the year you sell it if you end up using the money you get from the sale and reinvest it into a qualifying business asset. Something like that. Hopefully you think that is simpler, but saying the same thing. And then we could say something like, you can do this under what's known as rollover relief or something like that, as long as certain conditions are met. Same thing is being said, but personally, I think that would be a simpler way to frame it to the client, and the client will appreciate it being framed in that simpler way. The replacement asset must be acquired within a 4-year window, beginning 12 months before and ending 3 years after the disposal of the original asset. Qualifying assets include land and buildings used for trading purposes, as well as fixed plant and machinery not forming part of a building. Okay. So again, everything that's been said here is fine. But what I might say is something like, if you do want to reinvest the proceeds, then we can talk about how you can make it qualifying or something like that. And then we can cut out the jargon. Or before writing this again, we can talk to them and be like, if you did sell it, what would you do with that money? Would you want to reinvest it potentially? Would you not? So they can get more information and therefore make this report close to the final version without needing to amend it later after the client's looked at it. So I think this continues now to do with rollover relief. So to qualify, the new asset must be, so this is further information about it. So what we can do then is we can cut out like potentially a full paragraph or shorten it by the length of a full paragraph, which would be appreciated a lot by the client. Okay, so now we're moving on to something separate, which is business asset disposal relief. So what they've said here, in some cases, business asset disposal relief, BADR, could provide a reduced CGT rate, currently 14%, subject to a lifetime limit of £1 million on qualifying disposals. The current higher rate for CGT is 24%. Okay, so again, could we simplify this sentence or this bit here to say something to the client that means the same thing to them, but doesn't include the jargon? Could we say something like, in some cases, you could pay less capital gains tax on the sale as long as it qualifies for something called business asset disposal relief? Would that work? And would it be simpler? I mean, face value, I would say yes, but let's continue reading. So, however, under our current understanding, the business will continue after the disposal, albeit on a smaller scale, and therefore the necessary condition of a material withdrawal from the business would not be met. As such, a BADR claim would not be available at this stage. Okay. So let's simplify this full paragraph then, because I think we can at this point. So essentially what we can say is there is an opportunity to pay less capital gains tax on the sale of this asset, but because you're currently planning to continue the trade, it wouldn't be available. So we've not talked about it further. If that changes, let us know. Something like that. And I think then we're going to significantly simplify that paragraph. But we've let the client know that we've thought about it and there is an opportunity there then. So I think that would probably suffice in this case. The only other thought I had around this is, could there be some rough calculations done to figure out like what the cash benefit to the client would be if it did qualify for BADR? Because I suspect the reason that they're not just going into full retirement right now and they're continuing the trade is because they don't feel like they have enough money for retirement. So they want to work for an extra few years to get that extra money before they do fully retire. And if the tax saving from getting BADR is something like, I don't know, let's just say it's £200,000, and that's more than enough to stop them having to continue the trade, then clearly it seems like it's worthwhile to just stop working, stop the business right now and get that extra 200k. But if that 200k isn't enough, then it makes sense for them to continue. So this is where I think having some level of calculations, even if it's estimates and not accurate at this point, will help make decisions and help the client come to a full answer. What you've just heard has come straight from a live webinar I did recently called the Tax Lab. The Tax Lab is where I take real scenarios that tax professionals face and I go through them live, giving my advice and guidance to help you become a better tax professional. The sessions are completely free. You can sign up at taxprofessionalspodcast.com/the Tax Lab. That's the taxprofessionalspodcast.com/the Tax Lab. But if you're interested in getting really good at providing tax advice, it's worth taking a look at my tax advice masterclass. In that, I teach a repeatable process that you can use to provide great tax advice. And after the masterclass, you'll doubt yourself less and you'll have more confidence when it comes to advisory work. The next one starts on the 26th of November, 2025. Go to thetaxprofessionalspodcast.com/TAM for details and to sign up if you want to. That's thetaxprofessionalspodcast.com/TAM. Both links just mentioned are in the show notes for this episode, which are in the details for this episode within your podcast player, and they're available at thetaxprofessionalspodcast.com/TTPP125, which just stands for the Tax Professionals Podcast, episode 125. But that's it for this episode. I hope you found the episode useful and have taken away something to help you to progress, develop, or improve your tax career. Until next time.